January was really interesting. There was so many things going on. Japanese rates were rising, which led to a lot of volatility. There was clearly a lot of geopolitics and concerns around what was going on with the US and militarily wise what they were doing. So that was quite an aggressive move to the north of South America, and that clearly had a little bit of an impact, probably more so on commodity or oil markets than anything. Fed chair announcement, so I think that instilled a bit of confidence at the end of the month, which I think is a positive. Seems like he's quite a business oriented, but also an experienced governor, so has had experience through the GFC in a role that was in a decision-making role there. So that's interesting. I think that's a positive, where it takes away an uncertainty which the market was worried about. When you've got someone who's trying to set policy through Twitter or X or whatever they're doing, it's and then backflipping or changing or watering it down, it's hard to know where to put your eggs. Yeah? So diversification is a key part of that, making sure that you're not too concentrated in any specific sectors, any specific companies, any specific industries, any specific countries. Being aware that there are a lot of different levers that can be pulled at any point in time, where that can help ballast and help generate outcomes on portfolios. So we keep that in the front of our minds when we're investing. That is a key component of knowing where the risks are, and being aware of what you're trying to do to manage those risks. And I think we're purposely looking at a range of different strategies and a range of different markets to make sure that we're not too concentrated or bring in unintended risks into portfolios as we're managing them. If we look at the Aussie dollar in the period as well, it's finally getting related to rates. Yeah, so I think as we've, I suppose, probably gotten through confidence that the export market will be robust, and we've got good demand for our exports, the focus has returned back onto interest rates and interest rate differentials. And so as we've had that increase in bond rates here, and that change of expectations around what was going to happen with the cash rate, which has now come into markets and into portfolios, you've actually seen the dollar strengthen. So we've gone from that sort of mid-60 ranges, so 64 to 66 that we seem to not be able to break out of through 2025. We're now up to that 70 cent level. So for January specifically, it was a positive month, but relatively benign in terms of point to point, start to end. And markets, if you look at US markets, Australian markets, have been relatively flat for the last few months. And I suppose as you head into the end of the year, things slow down a little bit in terms of news-wise. Now we're kicking into the new year, we're getting back into reporting season mode, so we'll start to see a few announcements, and you'll see more company-specific volatility. So we saw Microsoft announce their update about a week ago, which started to see their price move around sort of 10% in a single day. And that's on the presumption that AI may not be playing out as a revenue generator to the levels that the markets were hoping for. So they're trying to monetize and trying to make money out of the AI boom that's going on. And some of the results that they were presenting were suggesting that it may not be as close to being something that will generate money for them compared with what the market was expecting. So the RBA moved on cash rates this week, and that was preempted by bond markets. I think there was an expectation once we started to see the higher inflation numbers from late last year, that was probably likely to come through. So that was expected, not really too much volatility in the markets as a result of that. But as you lead into that, clearly things change. So if we look at where 10-year bond yields were in December, they were about 4.2 or 4.3% here, which was about the same level as what it was in the US. They were relatively comparable. And there's been quite a divergence now between the Australian 10-year yield and the US, given what has actually come through in the inflation numbers. So that's the markets trying to get ahead of what the expectations were with the cash rate. They're about 4.8% now, so it's quite a big difference, which has an impact negatively on the price of those sorts of securities over that period of time. But the yields that are there are still enough to compensate for some of those changes in the yields that are playing out. So, fixed interest rates and returns of that 4 to 5%. It's certainly not the low rates of where we were in the 2010s. So there's clearly a bit of a reset from the interest rate markets over the last handful of years. We've gotten through COVID. We've gotten through a very long period of very low interest rates. I think now we're probably in a bit more of a normal period where the central bank can be in a position where they can, I suppose, play within a range that, assuming inflation remains under control, that you've probably got a bit more confidence that you'll get a reasonable outcome from fixed interest markets over the journey. Thinking of the materials market, so there's different commodities clearly that fit into the materials broadly. So iron ore and coal are part of that. There's other precious metals as well that come in as well. Gold is clearly one, and certainly over the last 12 months, as there's been uncertainty in markets, there's been a lot more demand for gold as a precious metal. That's led to really good support for gold companies, which may not have been that profitable if you go back to where gold prices were, say, 12 months ago. That uncertainty has led to certainly much more demand for the support for the precious metals specifically. But it has been very volatile. And so as we get to higher prices, you're starting to see lineups out the front of the mints and the like that sell, where you can go and purchase the hard commodity. But if we see some of the announcements that have come through, once you do get a positive announcement in markets, one of those was the announcement of the Fed chair being appointed or nominated as the preferred candidate. That starts to take some of the interest out of those more speculative markets, or markets that were being positioned for some of that uncertainty where people didn't have the confidence on the outlook.